Good morning, everybody, and welcome to our final IFRS and corporate reporting webinar for 2023. It actually sounds very scary when I say that out loud, because it feels like just yesterday that we started with the first webinar for the year. But here we go. So welcome to this webinar. Welcome, Kevin. Lovely to have you here. As you know, always joined by Kevin Frohbus, our partner of IFRS and corporate reporting based in Sydney. Hi, Kevin.
Hi, Aletta. How are you? And good to be here for the last webinar. And I think we're all a little bit exhausted. So we've given the biggest possible topic ever, business combinations and consolidations. But nice to be here, and hello, everybody.
One thing is true about us, Kevin. We set up this schedule at the beginning of every year, and we execute it till the last day of the year, right? So this is the last one for the year, and it's another tick, another successful year. Thank you very much for all the contribution throughout the year, Kevin. I would like to start by acknowledging the traditional owners of the land on which we meet today and pay our respects to elders past and present. And we extend that respect to Aboriginal and Torres Strait Islander peoples here today. Now, we've just talked about ending the 2023 webinars, and Kevin, it's out, it's on the website. We have scheduled our 2024 IFRS and corporate reporting webinar series. And we're starting on the 24th of January, even before Australia Day. But if you miss it and you're still on leave, you can always watch the recording. And it's our normal topic, what's hot and what's not in 2024. And then in February, a really important topic, looking at classification of liabilities as current versus non-current, all the latest developments. And then we do a refresher of a number of things around revenue. We know a lot of questions continue to pop up, leases, our update in May, etc. So there you have the whole schedule for the year. Towards the end of the year, you'll see we also have, well, actually the last one, next December, we have a webinar on the new IFRS 18 presentation and disclosure in financial statements. We're leaving it till last. We're hoping the standard will be issued by then. That's what the work plan of the IASB is indicating. So you'll see it's a nice combination of new items, revision of problematic areas, and also looking at brand new standards. If you use that link, register here, you can register for all these webinars. It's on our website, and all previous webinars. So Kevin and I have been doing this for 7 years. Next year will be the 8th year that we're running these monthly IFRS and corporate reporting webinars. If you want to look at any of the previous recordings, look at any of the slides, it's available on the website if you click that link. What we've also done is we've scheduled our sustainability webinar series for 2024. Tomorrow is the last one for the year for 2023, where we look at decarbonization. But next year, we're going to focus on all the new requirements in IFRS S1 and S2 as entities are getting ready for their first mandatory reporting, which will be 30 June 2025. But you have to start capturing all that information 1 July next year. So we kick off the year with the latest Australian developments. As you know, the Australian Accounting Standards Board recently issued an ED. They're suggesting to make quite a few changes to IFRS S1 and S2, with which I'm personally very unhappy. But I'll share those changes and our views on that. Comment letters due to the AASB on the 1st of March. And then we talk about activating sustainability at your organization, developing a roadmap, understanding carbon accounting, why it's important, setting targets, developing a decarbonization strategy. What's the role of voluntary and mandatory reporting? How do we assess climate-related risks and opportunities? How do we use climate-related scenario analysis to assess climate resilience? We focus on processes and policies to manage climate-related risks. We try and understand relevant climate-related metrics, including industry metrics. setting climate-related targets, and then climate-related disclosures in Australia. So really, I would say the whole year in sustainability is very much at activating, getting ready for sustainability, whether it's mandatory, voluntary, or just activating a strategy. So we thought many of you would also be interested in the sustainability webinar, and you can webinars, and you can register for those using the link as well. So back to today's agenda. So Kevin and I just talked about it beforehand. We scheduled this topic last year this time in anticipation of the International Accounting Standards Board finalizing their project on business combinations under common control. However, I think a week or two ago, the IASB indicated that they are abandoning the project. They're not going ahead with the project. They considered whether they should limit the scope of the project to just look at disclosures, which would be appropriate for common control transactions, or whether they should completely abandon the project. The recognition and measurement and disclosure was all within scope of the project initially. Unfortunately, they've decided to abandon the project. And for us, it's really disappointing because we really wanted to share that today, number one. But more importantly, it's disappointing, I think, for users of financial statements because business combinations of entities under control have been a problem for many, many years, since the adoption of IFRS in 2005 in Australia. It's one of those ongoing problems that are really difficult, really tricky, very judgmental. And I know preparers, auditors, users alike have all been looking forward to the outcome of this project. So very disappointing, but I think that's the latest and greatest news. Kevin, you wanted to add something? Okay. Sorry, it just looked as if you wanted to add something. So I don't know you that well yet, Kevin.
No, I was trying to put my button on off mute. No, Aletta, I think I'll just reiterate that it's quite disappointing, and I think the message to come out of it is business combinations under common control. As you'll see today, there's a lot of judgment and policy setting involved. And there are a lot of different ways to do it, but I think what's going to happen over time now is those views and ways are going to become entrenched. And you just need to make sure that when you setting up a transaction which involves businesses under common control, make sure you're apprised of all the alternatives available to you and when it's appropriate to use which one. I think the important thing here is it's not a free-for-all when it comes to business combinations under common control. There is precedence and historical ways to do things, but I think there is a view that it's kind of do whatever you want here. That isn't actually the case. You have to design a policy that's relevant and reliable and all those concepts under IFRS. And you really do need to look at all the alternatives available and the substance about what's going on. So although we don't have much to bring to you today in terms of what we thought the IASB's views would be on this, my message on this one is it's not a free-for-all. And because they've abandoned the project, make sure going forward that you are aware of all the alternatives and the reasons behind those alternatives, and really design the most appropriate and relevant way through to achieve the outcome in terms of reporting.
Kevin, I think that is perfect. That's 100% correct. I think, as you say, not free for all. We have to understand the transaction, the substance of the transaction, what's really happening, the commercials around it, and pick the most appropriate, because there are certain alternatives which in specific situations are completely not appropriate, and you don't want to be in that space. So it's an area where you have to consider and document very carefully. So today's agenda, we're looking at IFRS 3. So we talk about when is it applicable, and then we step through the 6 steps of IFRS 3 and remind you of, step 1, critically important, is a transaction a business combination that's within the scope of IFRS 3? Identify the acquirer, determine the acquisition date, measure the consideration, and then step 5, really important, recognize and measure assets acquired and the liabilities assumed. And Kevin, we've had a number of these recently in step 5, which involved leases. Actually, my favorite topic, as you all know, because when an acquirer recognizes and measures assets acquired and liabilities assumes, that will include right of use assets that they've acquired and lease liabilities, and make good provisions that they've assumed as part of the transaction, and fit out in included. So it's a really topical area, and I'm finding that overlap between IFRS 3 and IFRS 16 can be really challenging, and important to have a look at that. And then finally, we look at measuring goodwill or a gain from a bargain purchase. So that's what we're looking at IFRS 3. I should also say, although we scheduled the topic a year ago, hoping that IASB will have some findings on common control, I think it's a really topical topic today. And I've actually seen so many transactions recently around business combinations, entities acquiring others. We're not seeing a lot of IPOs, but we are seeing a lot of mergers, and we're seeing a lot of business combinations. And whether it's for-profit or not-for-profit space, you can see that strong entities are buying other entities, consolidating a position, consolidating a supply chain, consolidating that value chain. So we actually see quite a lot of this. And therefore, I think it's still very relevant. Last year, or in COVID, we saw a lot of IPOs, but now it's more the normal business combinations.
Aletta, and I'll just kind of add to that, because as you go through today, Aletta's going to do the first couple of steps, and I'll do the ones at the end. But I agree with you that there actually is a lot of M&A transactions out there. It's just not happening in the IPO space. And one of the things that I will talk about throughout today's session is the acquisition of one entity by another entity where they've got a pre-existing relationship. That is really important. And to be honest with you, I'm not kind of putting anything out there that's not already in the market, but a good example of that is the Chemist Warehouse tie-up that's currently happening out on the market. That was an integration of essentially a value chain or a supplier chain, so the two parties deal with each other already, or they have a relationship already. That complicates the accounting for a business combination quite dramatically. And I would say that I've seen at least 5 or 6 of those this year, where there have been complicated pre-existing relationships between the entities, and you need to deal with that before you do the IFRS 3 business combination accounting, because you've got to essentially account for the pre-existing relationship between the party as part of the lead up or as part of the business combination accounting. So that is something that is very topical. And if you have an acquisition which involves entities that have a pre-existing relationship, which is very much common at the moment, you know, supplier chains, value chains, entities essentially emanating in that sort of value chain, please take that on board, and I'll refer to that as we speak today. In this webinar.
Yeah, no, I agree. Thank you, Kevin. So we want to start with what is or when is IFRS 3 applicable? Now, I love a good decision tree or a flowchart, as I think most of you would know, and Kevin often makes fun of. But here we go, starting the webinar with another one. First question, has the entity opted to apply the optional concentration test? Now, where do I come from? IFRS 3 has been amended a couple of years ago, and it's introduced an optional concentration test. And that concentration test is a way to, I would say, shortcut the big assessment of whether the entity has acquired control of a business. So the very first question is, before we ask whether we've an entity acquired control of a business or not, you know, how are they going to assess it? Have they opted to apply this optional test or not? Because if they have, the next question on the right-hand side would be, have we met this test? And if we have, then we say, hang on, this is actually an asset acquisition. So the optional concentration test, if you think you might have an asset acquisition and not a business combination, you would try it. You'll do the test as set out in IFRS 3. If you're successful, it's an asset acquisition. You would not apply IFRS 3. However, it could be that you have a go at the concentration test, the optional concentration test, and you realize we cannot meet it, and therefore it's not automatically a business combination within the scope of IFRS 3. It just means you are back to the normal assessment, the long assessment on has the entity acquired control of the business. So from the right-hand side, you're back to the main area on the left-hand side. And there we're looking at, has the entity acquired control of the business? So we would look at what is control, what is a business, and if we say no, doing that full assessment, then it could be an asset acquisition. And again, if it's an asset acquisition, we would not apply IFRS 3. We apply the requirements of the relevant standards. So for example, we look at IAS 16 if it's acquisition of property, plant and equipment. However, if we've done this assessment and we've got, we've acquired control of the business, a next consideration, before you automatically just apply IFRS 3, a very important consideration is, are the acquirer and the acquiree under common control? And if you say yes, right on the left-hand side, it's outside the scope of IFRS 3. You would not automatically apply the acquisition method set out in IFRS 3. You could potentially apply it, but as Kevin said, it would now depend on the facts and circumstances around that common control transaction. There's a number of alternatives to consider. You might apply IFRS 3 or you might not. The issue is you are officially outside the scope of IFRS 3. You might, in certain situations, apply IFRS 3 by analogy. So that's a real problem area. If you said, no, we're not under common control, then you've got a business combination within the scope of IFRS 3. So you can see there's a lot of considerations before you open IFRS 3, and a lot of understanding. And Kevin, I would think the most important and often the hardest thing is, before we grab an accounting standard to do the purchase price allocation, etc., is to understand what's happened. So who's the acquirer, the acquiree, why did the transaction happen, what are all the surrounding facts and circumstances, as you've indicated, what are the pre-existing relationships, and often a lot of this is, why is this transaction happening? Because that gives you the context.
I think, Aletta, as well, we always say, for those of you who are long-term listeners, that the skill in IFRS is actually understanding which standard you're in. That's actually the specialism. And this is all about what's actually going on, what's the substance of the arrangements, what's the business and commercials of it, and then the scope requirements, which standard am I in? And a lot of what's going on here is, are you actually in IFRS 3 or are you somewhere else?
Correct. And the other thing, I just wanted to put that optional concentration test in perspective as well, because a lot of people get a bit confused about it. They say, can I do the optional concentration test and then I've got a shortcut into IFRS 3? No, it's not the case. If you don't meet that optional concentration test, you just back into the normal assessment. But important to understand how all of that works, and we'll discuss the optional tests shortly. So if you end up with an asset acquisition, so that would be the optional concentration test you would satisfy, or you've done the whole long assessment and you've realized it's not a business combination, it's actually an asset acquisition. How do we account for it? The acquirer shall identify and recognize the individual assets that they've acquired. So including all the intangible assets. So whatever we've acquired, the acquirer will recognize, and they will recognize liabilities they've assumed. What's important here is the cost of what was paid for all of these assets and liabilities will be allocated to all those individual identifiable assets and liabilities on the basis of their relative fair values at the date of purchase. the most important part here, because it's allocated relative to fair values, such a transaction or event does not give rise to goodwill. To contrast and compare this with a business combination under IFRS 3, you would recognize assets acquired, liabilities assumed at their fair value at acquisition date. And then the difference between what you paid, in a simple explanation, what you paid and the fair values will give you goodwill or a gain on acquisition. Here, that doesn't happen because we don't book the assets and liabilities at fair value. We just allocate what we paid across everything we've acquired relative to their fair value. So it's a very different approach. Then we've talked about common control. And I suppose in its most simplistic, if we've got a parent with two subsidiaries, and let's say subsidiary B has two sub-subsidiaries, D and E, and subsidiary C has a sub-subsidiary F, in its simplest form, if subsidiary C acquires sub-subsidiary D from subsidiary B, what happens is that sub-subsidiary D just moves in this tree and it now sits under subsidiary C instead of sitting under subsidiary B. So really, parent A is still in control of this whole group, and parent A still have common control over everything in this group. And therefore, in this transaction, if we unpack it, it's actually just an internal reorganization. And parent A can move the deck chairs however they want, because parent A is in control. And this entity has moved around within common control. So really, is it appropriate in that situation, number one, to fair value assets and liabilities at acquisition date? One would argue no. Why would we just fair value assets and liabilities if nothing has changed in the group? And is it reasonable to book a goodwill or a gain when it's just an internal reorganization? So this is a very simplistic example on common control, and I think everybody would say we are uncomfortable with fair valuing assets and liabilities, and we are uncomfortable with booking a goodwill or a gain. Common control is not always as simple as this one, but it just gives you some idea of what common control would be. If we look at the next one, maybe another example that we see quite a bit is what we call top hatting. And really, often what happens with top hatting, or the reason top hatting happens, is an entity or a group is getting ready for a transaction. So on the left-hand side, we have three shareholders of a parent A, and you can see they've got their subsidiaries. So that's before we're doing the top hatting. What they do on the right-hand side, they decide to insert a new company above the parent, but nothing else is changing. So shareholder 1, 2, and 3 are still the shareholders in the same percentages. So the same shareholders, same percentages in this new co as we had in parent A, right? So we're just inserting an artificial new company. Nothing else is changing. Again, in this situation, should we say that NewCo has acquired parent A and therefore NewCo now fair value assets and liabilities acquired, and NewCo have to book goodwill and gain on an acquisition? I think many people would say uncomfortable with that, because it's just an artificial new entity that's been inserted. Nothing else has changed. Now, again, there could be a lot of reasons for this happening. There could be a lot of different alternatives. There could be a slight change in shareholders, etc. But this is a very basic example of top hatting. And again, Kevin, we would ask the question, why are we creating this new entity? What else has changed? Understanding the steps in the transaction. Often there's a number of steps to execute a merger and an acquisition. So a very common question that we're being asked is, how is this top hatting recognized? And we'll throw out a few, and you'll see similar to common control, because top hatting is actually just another example of a common control transaction. You know, in that newco's separate financial statements, one would argue that that newco, who now has an investment in the parent, should just record that investment at cost. And so what is that cost? So it's newco's share of the parent entity A's equity at date of this transaction or reorganization, as it's shown in parent A's financial statements. So whatever we had in parent A's financial statement, that really becomes the cost in this newco. So we're not fair valuing and not putting a goodwill in newco. However, if you look at newco's consolidated financial statements, we know this is a common control transaction. It's officially scoped out of IFRS 3, but you would still potentially consider, based on facts and circumstances and what's really happened here, whether maybe we should apply IFRS 3 by analogy, because this could potentially be a reverse acquisition, or do we use the pooling of interest method? And that would be an accounting policy choice, which will clearly explain. But as Kevin said earlier, accounting policy choice doesn't mean it's a free-for-all. It does depend, based on the facts and circumstances, let's select the appropriate accounting policy. But again, you can see there's a number of issues we're dealing with here. Common control, and whether you've got a business combination or not, it's not simple. And Kevin, I would say usually you and I get involved in this early stage, because once we've picked it's an asset acquisition or it's a business combination, or we're applying IFRS 3, or we're doing pooling of interest method, you know, I think that's game over. Everybody's then happy to do whatever they have to do. But it's this initial part that's really complex. And I think people have to be really careful about.
But can I just say one last thing there, Aletta? On the previous slide, where you had option 1 and option 2, I've started to realize that our use of the word option is also controversial sometimes. Option implies a choice. Be very careful. Choice isn't actually always a choice. Maybe what we should be saying there is it's alternative 1 and alternative 2, but sometimes alternative 2 can't be applied depending on the relationship. These are very, very real problems. And we have seen scenarios where you dive into one of these, you think you're going to get a certain outcome, you go forward with the deal, and then when you get to your first financial year end, your auditors suddenly have a problem with what you've done. My advice on this is, before you do the reorg, get some help if the accounting is important to you. Obviously, sometimes the accounting is not the main purpose of what you're trying to achieve, but if it is a consideration, just get some help on this if there's a group or a common control or a reorganization or a top hatting, all those types of things where control isn't actually moving or shifting. Just get some help before you dive into it, because there can also be roll-on tax implications as well. And then maybe that's something we haven't really sort of mentioned yet.
I agree. Thank you, Kevin. Then if we look at step 1 around, is a transaction a business combination? Kevin, I realize, you know, we're halfway through the webinar and there's a number of steps left. So I'm going to just do it a little bit faster, because I know step 5 is where there's a lot of discussion and more problem areas. So I think it's important we've given everybody comprehensive slides again, but I might not do everything in detail. To me, the first part was really important, understanding the context. So is the transaction a business combination? We're back to, remember, the concentration test is optional. If you don't meet that, you have to do the full assessment. You'll consider if it's common control, etc. A little bit on the optional concentration test, there's often some question around it. The purchaser can make an election for each acquisition to either use or try and use this concentration test or not. When would we use it, really? You would say, if it appears that the majority of the fair value of the gross assets is concentrated in a single identifiable asset or a group of similar identifiable assets, if that's what it looks like. So does it appear? So it just looks like, right? We don't have confirmation, but that's the feeling. In that situation, one could say, acquirer, maybe you could have a look at the optional concentration test, because if you meet it, you will get to an asset acquisition fairly quickly. If it doesn't appear like that, and you can see there's a lot of very different assets being acquired, I mean, just opt out, don't even go there, because there's no way you can meet it, right? And then you have to perform the normal assessment anyway. So the optional concentration test cannot get you to a business combination quickly. It can get you to an asset acquisition quickly. All right, so that's a little bit of background on that. If you now go to the long approach, assessing whether we've got a business combination or not, a business, remember, it's have we acquired a business needs a minimum of an input and a substantive process. So we need inputs, substantive process that significantly contribute to an ability to create output. So we don't need outputs per se, but the ability to create outputs, then we've got a business. So the emphasis here is actually on that substantive process. Usually it's fairly easy to see whether we've got inputs or not, but that substantive process, do we have that? So if we look at if that process that we've acquired, if it's a substantive or not, we would ask, does the set of activities and assets have outputs at acquisition date? Because depending whether you already have outputs at acquisition date, you do a different assessment around whether the process is substantive or not. So if you say we don't have outputs, then you have an analysis of a set of activities and assets that does not have outputs at acquisition dates, as opposed to a different assessment if you already have outputs. So that's just linking into these slides. So in this one, if you look on the left-hand side, this is an analysis that we perform if we do not have outputs at acquisition date. So what would we look at? Is the acquired process critical to the ability to develop or convert acquired inputs into outputs? So we don't already have outputs, but is this process critical to get there? Do the inputs acquired include an organized workforce that is highly skilled, knowledgeable, or experienced to perform the acquired process? So, do we have this critical workforce? And do the inputs acquired include other inputs that the organized workforce could develop or convert into outputs? So do we have IP, etc.? If we say yes to all of that, you'll say that acquired process is substantive, although at acquisition date we don't have outputs yet. If we have outputs at acquisition date, there's two different approaches you can follow to assess whether the acquired process is substantive or not. So you go from the top part, or you can go from the bottom part. Two different approaches. So is the acquired process critical to the ability to continue to produce outputs? And again, the second question is around an organized workforce. That is, if you start with approach 2. Approach 1, does this process contribute to that ability? And again, we talk about whether the acquired process is a scarce or unique process that we cannot replace without significant cost. So that's just giving you a little bit of an idea on, in step 1, how do we assess whether we've actually acquired a business or not? If we move on.
Can I just have a very basic example? I run into this all the time. Entities assume that because there's revenue, there's a business. That's not necessarily true, which is essentially what Aletta's been talking about. And the other one is in-process research is the topic of the moment when it comes to acquisitions. And that is because a lot of entities have got good ideas, they're startups, they're in the development or research phase, and they need money, and the way they get money is they bring other partners in, so therefore sort of a business combination emerges. In-process research and development is a classic example of, do I have a business or do I have an asset acquisition? Because in-process research and development might just be exactly that, a process that's hasn't developed any asset yet, or hasn't actually given rise to a substantive process, etc., etc. So those are the two areas I'd just say, bearing in mind, if there's in research process and development, and or if you've got revenue, but perhaps you aren't acquiring all the employees, there's a lot of risk around, do I have a business combination or do I have an asset acquisition?
Absolutely. If we then, as you can see on this slide, step one sits a little bit to the side, because if it's not a business combination, we're outside the scope of IFRS 3, and then we're a world of pain. So what is it? What is most appropriate? You might even come back into 3, but that is a critical step because you might apply IFRS 3 by analogy. If we now move on, we have a business combination. Steps 2 to 6 now become relevant. We apply the acquisition method. So you identify the acquirer in step 2. So it's the entity obtaining the control of another entity. There's guidance in IFRS 10 consolidated financial statements around when do one entity have control of another entity. And the definition talks about an investor must meet all the criteria. So power over the investee, exposure to risks and returns, and the ability to use that power to affect the amount of return. So the third one actually links 1 and 2 together, and this is out of IFRS 10. I like this particular slide, which Alison and our team have put together, and that is when we identify the acquirer, there's a lot of things to consider. The yellow block says, if we've got a business combination which is primarily affected through cash or other assets, what do we do? The acquirer is usually the entity that transfers the cash or the other assets or incurs liabilities, right? There are other factors around relative size. There's other factors around who initiated the transaction, but the blue bit here is interesting. If we've got a business combination that's affected primarily through exchanging equity instruments, Kevin, we see that a lot. Exchanging equity instruments, the acquirer is usually the entity that issues the equity instruments. However, I think that's an oversimplification. Usually the entity that issues the equity instruments, but there's a lot of other factors. So we have to look at relative voting rights in the combined entity, the existence of a large minority voting interest, the composition of the governing body, the composition of senior management, and the terms of the exchange of these equity interests. So identifying the acquirer is actually a combination of what we find in IFRS 3 and IFRS 10 around control. And I think in this slide, we try to combine it and say these are all the criteria to think about. Again, this is a difficult one. Often in complex transactions, something that looks like some kind of a merger, but we've decided it's not a merger, it's a business combination. Identifying the acquirer is very tricky because there's been a lot of exchanging of instruments. So who really is the acquirer in that transaction? It's critically important because the assets and liabilities of the acquiree are fair valued, not that of the acquirer. And also, the acquirer would book those, the goodwill or the gain. So there's another thing to consider, just to throw another topic into the mix, is what about a reverse acquisition? So when we identify the acquirer, it often looks as if one entity is just buying another entity, but when you unpack it, it's actually a reverse acquisition. Because potentially, let's say a large private company with a very successful business is being legally acquired by a listed shell on the stock exchange. So although it looks as if that shell listed entity is buying this hugely successful operating entity, it's actually the opposite that's occurred. It's actually a reverse acquisition, because usually the shareholders of this big operating entity now become the shareholders of that listed shell. And, again, they're just using that listed shell. It's like an acquisition, a reverse acquisition. So often we see this with private companies being acquired by a listed entity. And we've seen that during COVID and just after COVID a lot. When we had IPOs, a lot of reverse acquisitions in that situation. We don't see that many at the moment. Determining the acquisition date, the third step, Again, it's the date the acquirer obtains control of the acquiree. And, you know, again, it's an assessment based on facts and circumstances, because usually that is the date, but it could be that control has been earlier or later than the closing date of the transaction. Usually it's the same date, but it could be different, and we have to make an assessment. And then in step 4,
I know in the interest of time, but can I just put on everybody's radar, the acquisition date is often in practical terms when all the conditions precedents are met. And that's just a rule of thumb, but you know, it's a good indicator, or it's a good place to start. That's obviously not always the case, but one of the complicated ones we find a lot is where you have a lockbox scenario, where the assets and liabilities and their values are locked at a particular date, let's say February, and then the transaction really only goes through in November. So you've got this 6 or 8 months between locking down the values in the agreement, but actually only 6 or 8 months later when all the conditions are met and the acquisition actually happens. And the acquisition date and the date that the values of the assets are locked down for purposes of the SPA have this enormous big gap between them. That needs to be considered when you're applying this, because the acquisition date does not follow the date of the lockbox. It follows the date of control passing, and that is really important.
Absolutely. Thank you, Kevin. Then in step 4, measuring the consideration. So that consideration at the date that control passes. So you can see this has to be done in a specific order. We need to know who the acquirer is. We need to know when control passes, because that impacts at the date that we measure the consideration, the date we measure the assets acquired and liabilities assumed. So the consideration transferred in a business combination usually consists of 3 key things. So acquisition date fair values of assets that the acquirer might have transferred in order to pay for the transaction, whether it's cash or other assets. Liabilities that's been incurred by the acquirer to former owners of the acquiree, as well as equity interest issued by the acquirer to the former owners of the acquiree. So, you know, it could be cash, other assets of the acquirer. There could be contingent consideration that will be paid to the former owners of the acquiree, contingent on a number of aspects. There could be deferred consideration. So we're not paying the cash now, it's merely deferred. It's not contingent on something happening. It's just there's a time delay, and there can be those equity instruments that's been issued. Deferred consideration, the future payment must be made. So it's unconditional that we have to pay it. There's just a delayed time frame. Contingent consideration is a future payment that may or may not be paid depending on certain conditions. So there's a difference between the two, because when we measure these, deferred consideration, it must be paid. We have a net present value, off we go. Contingent consideration, we consider also, in addition to net present value, the probability of us paying that. So that's a little bit of a repeat of that. And this is just some examples of expenses that when you incur these items, they are expensed as incurred. They're not capitalized. And it's important to take that in consideration, your finder's fees, legal fees, valuation fees, etc. Kevin, I want to hand over to you for steps 5 and 6, because I think it's important to have a look, especially at step 5. So over to you.
Thank you, Aletta. And that was it's a good segue. The reason why we've done a bit of a segue between step 4 and 5 and Aletta's handing over to me is because it's normally at this point that we find all sorts of complexity arises in the actual practical implementation of this. Most of the first few steps that Aletta did, so identifying the acquirer, is it a business combination, those are essentially scope and recognition questions. Once we get to step 4, we've gotten past, do we have a business combination? Clearly we do. We know who the acquirer is. We know what the date of the acquisition is. So that's the date that it's going to be recognized for the first time because control passes. So generally, I want to say all the hard stuff has been done up until then, but really it's actually just the beginning of the hard stuff, because once you actually get to step 4 and 5, now you need to put values onto everything. And really, you can see from what Aletta has done is that up to step 4, or the start of step 4, is really what is the consideration, and the consideration is measured at the date a control passes at fair value. And then the idea of step 5 is then to essentially allocate what you've paid to everything that you've acquired on a line-by-line basis. So that's why it's called, in valuation parlance, it's called a purchase price allocation, because you're allocating essentially the purchase consideration out to all the line items that you've acquired. Now, I'll get into the technical now, so let's just leave this on the screen just for a moment. There is actually logic to doing the consideration first and then the allocation. Because what actually happens a lot in practice at step 4, you start to question your mindset and whether you've actually done this properly, because you will find that the acquirer and the acquiree, or shall we call it the vendor and the acquirer, they've made a whole bunch of side deals at this point. During the negotiation phase, what often happens is the acquirer and the vendor or the sellers will come up with all sorts of side agreements, because you've got to decide how to settle the existing liabilities with the bank, or you have to deal with redundancy payments, or you have to, decide on how you're going to settle existing share-based payment arrangements that existed with the former owner. And so what happens at step 4, often you'll find there's a whole bunch of payments that are being made at step 4, but they don't necessarily go to the former sellers. So at this point, between step 4 and 5, it's important that you actually understand that when you're measuring the consideration paid, that it actually is part of the business combination accounting. Because sometimes there's a lot of transactions going on, especially with the former vendors, that actually aren't part of the business combination accounting. They're actually side arrangements or separate transactions that have been undergone as part of the negotiation of the SPA to essentially exit the former owners, but they're actually not part of payments to acquire the business. They're essentially what we call settlement transactions or pre-existing arrangements. I'm making that point because you will often find, before you jump to step 5, that you will start to question whether all of the payments that have been made at step 4 are actually part of the business combination accounting. Now, we haven't actually done a lot of that in the slides today, but I just want to put that on your radar. You need to be very clear in your mind that if a payment is being made as part of the consideration at step 4, that it's actually part of the business combination accounting, that it's not some separate transaction that has happened outside of the acquisition accounting, or is some settlement transaction to essentially get rid of the former sellers, and you're really just settling some sort of pre-existing relationship. That's important because you will often find that if you get the consideration wrong at step 4, that you will identify the wrong assets at step 5. So just want to put that on your radar. So make it a bit of a segue, because if something is inaccurately identified as part of the consideration, it's going to be inaccurately allocated to an asset in step 5 as part of the identification. I made reference earlier in the session today about mergers and acquisitions happening between entities that have a pre-existing relationship, and that's a good example. If the acquirer and the acquiree, let's say, used to have a pre-existing relationship, they used to sell goods to each other, or they had some sort of distribution change going on, that needs to be effectively accounted for as a settlement before you account for the business combination, because the relationship between the acquirer and the acquiree is essentially going to consolidate out once you account for the business combination. And you will find that if you don't do that correctly before step 4, you are going to inaccurately or incorrectly allocate assets that don't exist at step 5. So I'm just putting that on your radar, something to think about. The concept in step 5 is, and now we can go to the next one, Aletta, is you need to identify everything that's been acquired as part of the acquisition, all liabilities assumed, non-controlling interest, and essentially measure those and recognize those at the acquisition date. In other words, allocate your consideration out to all the assets and liabilities acquired and non-controlling interest. And then the balancing figure, in inverted commas, is either goodwill or bargain gain. Now, not everything is at fair value, but the vast majority of identified assets, liabilities acquired, and non-controlling interest of the acquiree is at fair value. We don't have enough time today to get into the exceptions to that rule, but just bearing in mind, concept is that everything needs to be valued at fair value, or most things need to be valued at fair value, which means you're going to have to be doing some sort of valuation of the net assets acquired and recognizing and measuring those. Jumping through to the next couple of slides, that's where I've said it. The recognition conditions for what assets and liabilities need to be measured. Essentially, I think that's actually the separate things there. Additional assets may be recognized in the financials that have been recognized in the financials. What this is basically saying is, from the acquirer's point of view, everything that is being acquired that can be essentially separately identified as an asset needs to be recognized and measured at fair value, irrespective of whether the acquiree has recognized it. And this is where you get wonderful new intangible assets, as a good example, suddenly appearing in a business combination, which may not have been recognized by the acquiree before. And that's part of allocating what you've bought out to what you've acquired. So it's really important that you work through this and you actually identify, especially your identified intangibles that have been acquired, and you recognize them out. So have a look what's on the next slide, Aletta, in terms of this. So the intangible assets are the big one, separately from goodwill. In other words, you can't just put everything to goodwill. You actually have to go through and understand your separable and contractual legal criteria to decide whether an intangible asset is separately recognized or should be recognized and measured at fair value by the acquirer. Now, there's a lot of technicalities going on here, but there's really two concepts. If something is a right that has been acquired by the acquirer and its nature is contractual or legal, you're going to recognize that and measure that at fair value by the acquirer, even if it can't be transferred separately from the acquiree. Now, why I'm articulating that is because the ability to recognize intangible assets in a business combination is much broader than just under the normal intangible asset standard. You will find that if you've got an intangible asset, the rules about what can be recognized as a separate intangible are quite tight under the intangible asset standard. And the reason for that is because the intangible asset standard doesn't want you to recognize internally generated intangibles. But when intangible assets are acquired in an arm's length arrangement, acquirer acquires control, business combination, those intangibles, there's a little bit more leeway here about recognizing those because they're not internally generated. They're actually acquired in a separate transaction. They're being bought by the acquirer in a business combination. So you will have a scenario under the business combination accounting that more intangibles than would normally be recognized by an entity can be recognized in a business combination. That is why you get things like customer lists suddenly appearing in a business combination, because a customer list would not be recognized by a normal entity in the normal course of business because it would be something that would be internally generated. But in a business combination, the theory goes that that customer list had value and was part of the negotiation for the acquisition of the business, and therefore part of the purchase price can be allocated to it, and that's what the standard requires. So that contractual legal criteria says if you've got a contractual right or legal right to something, that right needs to be recognized, even if you couldn't sell that right separate from the business. The separate criteria is another one. If you could sell something separate from the business or license it or transfer it, that meets the separable criteria, and it too should then be recognized as an intangible asset in a business combination. Why are we putting this out there is because we find in practice that entities don't do a thorough search for all the intangibles they've acquired. And a good rule of thumb is if it was part of the negotiation and part of the consideration or the purchase price for the business combination factored the existence of that right or criteria in, then there's a very good chance there's actually a separate intangible there. In other words, if you paid for it or you bought it and you paid a part of the consideration was for the right or the legal right or the separable asset that could be sold, and you actually put a price on the business because that right or that resource actually attracted some part of the consideration, most likely there's a separate intangible asset there that can be recognized. So don't just look for the obvious one. look for the ones that actually have a legal or contractual arrangement, or which could be separately sold, transferred, or licensed. I can guarantee you that you're going to have an intangible there that needs to be recognized. Now, the rest of the slides here, and later we can kind of jump through them really quickly. These are just going to be examples of the sorts of things that you're going to find that are most likely going to be separate types of arrangement. The ones that I want to point out, just for purposes of the discussion and in interest of times, customer lists generally, or customer relationships generally do satisfy the recognition to be separately valued, and the reason for them is because you can license or sell them. You can sell the details of your customers to some organizations, but just bear in mind there are some privacy concerns here. Not every customer list or customer relationship could be licensed or transferred. You can't sell all of them. Now, that's particularly true in public sector type arrangements and entities where there are significant privacy laws that cover the use of customer relationship details and customer rights. So not every customer right or relationship could actually be licensed or separately transferred, because there may actually be restrictions on the ability to sell them. So unless they are legal rights, then there might not be separate relationships. The other one that's often missed is a non-compete arrangement in a business combination. You often, the former owners can't go off and compete against the business they've just sold. That non-compete arrangement is by definition a legal right, and legal rights satisfy the contractual legal requirement, so they often do have value and they can be valued as a separate intangible, often missed. So those are the sort of two that I come up against a lot. Here's a good list of the sorts of things we often look for which are missed. Things like patents that can be licensed to third parties, backlogs or order backlogs on purchase orders. Those are customer relationships that are contractual. In-process research and development we've spoken about already, but that's something that can be licensed or sold separately. So there it is. Spoken about customer lists, and then operating leases with favorable terms that cannot be transferred or sublet. These are things that you have to look at, because if you've got an operating lease and it's got favorable terms on it, even if it cannot be transferred or sublet to someone else, the fact that the terms are favorable makes it contractual or legal again, and those favorable terms need to be considered. So those are things to kind of look for. On the next slide, Aletta, there was a list that we gave in terms of things that may also, examples of intangibles that may meet the recognition criteria. I think we've met some of the, we've spoken about some of these already, but favorable supply contracts and favorable sales contracts, the key word there is favorable. If you've got a supply contract and it's favorable from a market perspective, you've paid value for that as part of the business combination, and therefore that value needs to be recognized. The other thing that's important here is that these are from the perspective of a market participant. So if a business is acquired and the acquirer doesn't plan to exploit the assets acquired. In other words, if you buy a business and let's say you have it's got a brand and you plan to discontinue the use of that brand, that doesn't mean you don't recognize the asset, because you need to recognize this from a market participant point of view. In other words, the brand has value, it does exist, and somebody would pay money for that. Therefore, it doesn't matter what the purchaser is intending to do with it, like discontinue it. The fact that the right exists must be recognized, and therefore that asset must be recognized on balance sheet and valued. It might just have a very short useful life after that because it plans to be discontinued, but that doesn't mean you get to not recognize it just because the acquirer doesn't plan to use it. All right, so I think the rest of the slides then, actually, these are examples you can go through yourself. I think we've spoken about operating. Some other things there is just contingent liabilities. A contingent liability generally wouldn't get recognized on the balance sheet by some organizations, in the normal course of business. But in a business combination, the acquirer has acquired that contingent liability, and that liability probably impacted the purchase consideration in some way. So the standard says, because the purchase consideration, step 4, has probably been impacted by the existence of that liability, then its fair value needs to be recognized as part of the acquisition. So in business combination accounting, you will have contingent liabilities recognized at fair value. Why? Because they influence the purchase price in step 4, and therefore the purchase price needs to be allocated out to them in step 5. So that's also just another key takeaway. It's 1201, but the big thing in step 6 with measuring goodwill, once you've got your purchase consideration and you've recognized all your assets and liabilities acquired and you stuck some non-controlling interest, the idea here is if you have a balancing figure, it's either going to be goodwill or it's going to be a bargain gain. I don't think we have to spend too much time on this step. I almost feel like, just like this webinar, once you get to step 6, you haul yourself over the line and you kind of claw your way to the end, and you essentially have a goodwill or a gain. I'll just caution gains. Gains are not, no one likes a gain from a business combination because it means potentially you've actually not accounted for something else correctly in the acquisition. The concept here is commercially, acquirers will pay more to acquire a business because of some synergistic type of reason, but it's very seldom that a gain arises because why would you get away with murder by paying less than what you acquired? So the standard, just like all commercial arrangements, says if you end up with a gain, you really need to go back and check you haven't missed something in the accounting. And I want to say that some of the regulators actually don't believe a gain can ever be acquired, can ever be achieved in a business combination. But I will say is I have actually seen them. In some of the M&As that are happening right now, some entities are trying to exit markets that they're in, and they are essentially handing the business over to management or somebody else in a geographical location because they're trying to exit some geographical locations. And so in some ways, they actually are entering into sales and purchases where they end up with a gain. But my warning to you is if you end up with a gain, go back and make sure you understand why you're ending up with a gain. Go and check that you've done all the other steps correctly. And if you do end up with a gain, still after doing all of that, you should actually be able to disclose the reason for the gain in the financials. In fact, I think it's a requirement to disclose it. And if you have a regulator who looks at that, I can almost guarantee you that if you publish a set of financials with a gain, with no explanation about where the gain came from, you're going to get a query. You're going to get a query from a regulator, and the auditor will certainly ask you a question at that point. So make sure you understand where your gain comes from if you do end up with one. I think that's the next slide, Aletta, but I'll kind of leave it at there for you to wrap up.
Thank you, Kevin. I think sometimes people get confused by the word gain. I actually like the use of a bargain purchase. You manage to buy something at a real bargain, and that's why you've got this gain on day one. If you've paid more for it than it's worth, it's an asset, an unallocated asset or goodwill. So, you know, why did you manage to buy a bargain? Really, that's the question the regulators and the standard setters are asking. Finally, if you need any assistance, I know 31 December full year reporting is coming up for some, or half year reporting for others. Please reach out to our IFRS and corporate reporting leaders and partners across our business. And this is our broader team. Please reach out to us. We would love to help you. Please register for our monthly corporate reporting insights or sustainability news, and or you can register for both. From an education and learning perspective, we've got e-learning available on IFRS 3. We've got a number of publications available on IFRS 3 and also a number of webinars. So you can look at our IFRS Learning Hub for additional information. I've got a bit of a reminder on our core sustainability services. Kevin and I are getting busy with carbon accounting and sustainability reporting. If you need assistance, please reach out to us. This is a little bit of an explanation of everything we do in the sustainability space. And then finally, again, a little bit of a brag about our 2023 sustainability report, which you can download. I would like to end by saying thank you very much for being on this webinar journey with Kevin and I throughout 2023. I know many of you have been on this journey with us for a good 7 years now. But thank you very much that you keep on coming back. We enjoy your company. If you've got questions, let's contact us. For those of you who do celebrate Christmas, I wish you a Merry Christmas. And we're looking forward to see you in January, in the new year, looking at everything that the new year is throwing at us, mainly sustainability. But thank you, and Merry Christmas, Kevin.
Bye. Goodbye, Aletta, and goodbye, everyone.